Welcome back to the AlgoBot channel, where we break down automated trading strategies for MetaTrader 5, one idea at a time. I'm AlgoBot, and today we're exploring an expert advisor called Dispersion Scaling Rotation. This strategy treats price like a moving particle and measures how the spread of its movements grows over time, using a single self-similarity number called the scaling exponent. From that one measurement, it decides whether the market is trending or mean-reverting, and it rotates its behavior to match. By the end of this video, you'll understand exactly how it reads the market and manages each position. Let's dive in. So what exactly is the Dispersion Scaling Rotation Expert Advisor doing? At its heart, it's a regime detection strategy built entirely from raw price data. It doesn't use a traditional indicator like a moving average or an oscillator you'd recognize from a standard chart. Instead, it borrows an idea from physics. It treats the log of price as a diffusing particle and measures how the spread of its movements grows over time. That measurement is captured in one number, the scaling exponent, and the whole strategy rotates around it. The key insight is that this single number can describe two completely different kinds of market. When the exponent is high, price is behaving like a self-reinforcing directional flow, which is a trending market. When the exponent is low, price is behaving like something confined, where stretched moves tend to be pulled back, which is a mean-reverting market. Rather than assuming the market is always one or the other, the strategy measures which one it is right now and adapts. Because of that, the same expert advisor can act as a trend follower in one regime and a fade strategy in another, all without changing its settings. In a trending state, it rides the direction of the recent net move. In a mean-reverting state, it fades statistical extremes back toward the average. When neither picture is clear, it simply waits. The strategy runs on a single time frame of your choosing and is designed for liquid markets where a diffusion picture of price makes sense, such as major currency pairs, metals, indices, or crypto. It's best suited to traders who are curious about a more quantitative, first principles way of reading the market and who want to understand the logic behind an automated system rather than just switch it on. As always, this is educational information only, and every approach carries the risk of loss. Let's break the dispersion scaling rotation strategy down into its moving parts. Everything begins with a single measurement taken once per completed bar, the anomalous-diffusion exponent, alpha. The strategy takes the log of each closing price and treats it like the position of a particle. It then measures the mean squared displacement, which is how far price has moved, squared and averaged, over 4 different lags: 1 bar, 2 bars, 4 bars, and 8 bars. In a plain random walk, that displacement grows in direct proportion to the lag. The strategy fits a straight line through those 4 points on a log-log scale, and the slope of that line is alpha. That one number sorts the market into 3 states. The neutral half-band, called ScalingBand and set to 0.15, defines the middle ground. If alpha rises above 1 plus that band, above 1.15, the market is super diffusive, meaning moves are compounding, and the strategy looks to trade with the trend. If alpha falls below 1 minus the band, below 0.85, the market is subdiffusive, meaning moves are being suppressed, and the strategy looks to fade extremes. Anywhere in between is treated as a random walk, and the strategy simply stands aside. In the super diffusive state, the strategy measures the net displacement over the last 4 bars, the drift span. That drift has to clear 30% of the current ATR to count as a genuine directional move rather than noise. If it does, the strategy enters in the direction of the drift, long if price has been rising, short if falling. In the subdiffusive state, the strategy standardizes the latest close against the window mean and spread to produce a z-score. If that z-score stretches beyond the revert z-score threshold of 1.2 on the upside, the strategy sells to fade it. Beyond it on the downside, the strategy buys. Risk is handled the same way for every trade. The stop loss is placed at a multiple of ATR, 2 times ATR by default, so it adapts to current volatility. The take profit is the stop distance multiplied by a reward figure that itself depends on alpha. Strongly trending readings widen the target up toward 3 times the risk. Snappy mean reverting readings tighten it down toward around 1 times the risk or less. Finally, if an open position ever finds the exponent arguing the opposite direction, the strategy closes it early. That adaptive exit is what lets one engine trend in one regime and revert in another. Let's look at the actual MetaTrader 5 code that makes this happen, just as you'd see it in MetaEditor. At the top are the input parameters. Windows sets how many bars the analysis looks back over, 60 by default. ScalingBand is the neutral half band around 1 at 0.15. Drift span and drift rfrac control the trend entry, how many bars the drift is measured over, and how much of the ATR it must clear. Revert z-score sets how stretched price must be to fade it in the other regime. ATR period and AtrSL multiple govern the stop, and lots is the fixed position size. Below the inputs are the two signal blocks. The first runs when the market is super diffusive. It calculates net move, the change in close over drift span bars, takes its sign, and checks that its size clears drift ATR frac times ATR. If so, desired is set to that direction, positive for long and negative for short, and the reward multiple is scaled up with alpha. The second block runs when the market is subdiffusive. It computes the mean and standard deviation of the window, turns the latest close into a z-score, and if that z-score pushes past revert z-score, it sets desired to fade the move, selling when price is stretched up and buying when it's stretched down. Finally, the order block sizes the trade. The stop distance is AtrSL multiple times ATR, and the take profit distance is that stop multiplied by the reward figure. If the signal is long, the code calls trade.buy with the stop below and the target above. If short, it calls trade.sell with the stop above and the target below. One compact engine, both directions, driven entirely by the measured exponent. Let's watch the dispersion scaling rotation strategy work through a full cycle on this illustrative chart. The candles are on top, and the panel underneath tracks the diffusion exponent, alpha, the single number that decides everything. Remember the map. When alpha climbs above 1.15, the market is super diffusive and the strategy trends with the drift. When alpha falls below 0.85, the market is subdiffusive and the strategy fades extremes. And around 1.0, it's an ordinary random walk, so the strategy stands aside. Look at the first few candles on the left. Price is edging higher in small steps, and down in the panel alpha is sitting near 1.0. This is the neutral zone. Dispersion is growing about as fast as a random walk would predict, so there is no measurable edge, and the strategy stays flat. Now watch candles 3 and 4. The advance picks up pace, each close reaching higher than the last, and alpha lifts through the 1.15 line into the super diffusive band. That tells the strategy the moves are compounding on themselves, that order flow is self-reinforcing rather than canceling out. But a rising exponent alone isn't enough. The strategy also checks the net displacement over the last 4 bars, set by the drift span parameter, and requires that drift to clear 30% of the current ATR. Here it does, and the drift points upward, so at the buy entry marker on candle for the strategy opens along in the direction of the move. Notice how the stop and target are sized. The stop sits 2 ATR below the entry, from the AtrSL multiple of 2, giving the trade room to breathe against normal noise. Because alpha is strongly super diffusive here, near 1.3, the reward multiple widens automatically toward roughly 1.8. The more directional the medium, the further the run is expected to travel, so the target is placed further away. Across candles 5, 6, and 7 price keeps stepping up, and at the take profit marker the long reaches its target and closes. Now the character of the market changes. After that extended push, price on candle 8 has stretched far above the rolling window mean, the gray cage center line running through the chart. In the panel, alpha rolls over and drops through the 0.85 line into the subdiffusive band. Subdiffusive means displacement is now being suppressed. The particle is caged, and stretched moves tend to be pulled back. The strategy measures exactly how stretched price is by standardizing the latest close against the window mean and spread, producing a z-score. That reading pushes past the revert z-score threshold of 1.2, and because price is stretched above the mean, the strategy opens a short at the sell entry marker on candle 9 to fade the extreme. This time the maths runs the other way. Because the market is subdiffusive and snappy, the reward multiple is clamped tighter, down near 0.9, so the target sits closer than it did for the trend trade. The stop is still 2 ATR, now placed above the entry. Watch candles 10 and 11. Price rotates back down toward the cage center. Exactly the behavior a subdiffusive reading predicts, and at the take-profit marker on candle 12 the short reaches its target as price settles back near the window mean. One more thing worth noticing across the whole sequence. The same engine produced both trades, a trend following long and a mean reverting short, without any change of settings. It simply read the diffusion exponent and rotated its behavior to match. And if a live position ever had the exponent argue the opposite way while it was open, the strategy would close that position early rather than wait, which is the adaptive regime flip exit built into the logic. And that brings us to the end of our look at the Dispersion Scaling Rotation Expert Advisor. We covered the core idea of treating price as a diffusing particle, how the scaling exponent sorts the market into trending, mean reverting, or random walk states, how the strategy enters with the drift in one regime and fades extremes in the other, and how it sizes every stop and target from volatility and the measured exponent. Remember that everything here is educational information only and not financial advice, a recommendation, or a solicitation to trade. Every strategy carries risk, and losses are a normal part of trading. If you found this breakdown useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling us which strategy you'd like us to explore next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.